By the end of this chapter, you will be able to distinguish between primary and secondary markets. Discuss the key indicators of securities markets. List the products traded in securities markets. Describe the participants of the securities markets. List the various market segments and the products. Discuss the reforms in Indian securities markets. The first topic is overview. In this topic, we will learn to distinguish between the primary and secondary markets. Let's begin by understanding the securities market. Securities markets provide a channel for allocation of savings to those who have a productive need for them. The securities market has two interdependent and inseparable segments. Primary market. In the primary market, companies sell new stocks and bonds to the public for the first time. And secondary market. Secondary market refers to a market where securities are traded after being offered to the public in the primary market or listed on the stock exchange. Let's understand the primary market first in a little detail. In the primary market, companies that wish to raise funds issue securities to the investors, who are the savers, with the help of merchant bankers. Investors in turn remit funds to the companies through these merchant bankers by subscribing to these securities. All operations in the primary market are governed and regulated by the Securities and Exchange Board of India, SEBI. Primary market provides an opportunity to the issuers of securities, both government and corporations, to raise resources to meet their requirements of investment. Securities, in the form of equity or debt, can be issued in domestic or international markets at face value, discount or premium. The primary market issuance is done either through public issues or private placement. Under Companies Act, 2013, an issue is referred as public if it results in allotment of securities to 50 investors or more. However, when the issuer makes an issue of securities to a select group of persons not exceeding 49, and which is neither a rights issue nor a public issue, it is called a private placement. Let's understand the secondary market in a little detail. Once the security is listed on the stock exchange, investors can buy and sell the securities from each other, with the help of intermediaries, brokers, dealers, sub-brokers. Order for buying and selling are placed with these intermediaries, who in turn place the order with the respective stock exchange. The exchange then matches orders wherein the buy and sell quantity and price match, and the trade is executed. After the trade is executed, funds and securities are exchanged by the investors through the stock exchange and the clearing and settlement houses. Secondary market comprises of equity, derivatives, and the debt markets. The secondary market is operated through two mediums: the over-the-counter (OTC) market and the exchange-traded market. OTC markets are informal markets where trades are negotiated privately between the parties to the transaction. Exchange-traded market is a formal systematic market where standardized trades are executed through an exchange. Now that we know what primary and secondary markets are, let's look at 5 key differences between these two markets. Difference 1. In primary markets, there is direct contact between issuer and investor, whereas in secondary markets there is contact between investor and investor. Difference 2. The aim of primary markets is to increase capital for issuer, while the aim of secondary markets is appreciation of capital for investor. Difference 3. In primary markets the flow of money is from investor to issuer, while in secondary markets the flow of money is from investor to investor. Difference 4. In primary markets the merchant banker is the main intermediary, while in secondary markets the broker is the main intermediary. Difference 5. In primary markets, purchase is outside of stock exchange, while in secondary markets, trading happens on stock exchange only. Please note, this being a capital markets dealers module, we will be conducting our discussions going forward based solely on the secondary market.
The key indicators of the securities market are index, market capitalization ratio, turnover, and turnover ratio. Click on each key indicator to learn more. An index is used to give information about the price movements of products in the financial, commodities, or any other markets. Stock market indices are meant to capture the overall behavior of the equity markets. The stock market index is created by selecting a group of stocks that are representative of the whole market or a specified sector or segment of the market. The blue chip index of NSA is the Nifty 50. Market capitalization is defined as value of all listed shares on the country's exchanges. It is computed on a daily basis. Market capitalization of a particular company on a particular day can be computed as product of the number of shares outstanding and the closing price of the share. Here, the number of outstanding shares refers to the issue size of the stock. Market capitalization is equal to closing price of share multiplied by number of outstanding shares. Similarly, to compute the market capitalization of all companies listed on an exchange, we aggregate the market capitalization of all the companies traded on the exchange. The market capitalization ratio is defined as market capitalization of stocks divided by GDP. It is used as a measure of stock market size. Turnover for a share is computed by multiplying the traded quantity with the price at which the trade takes place. Similarly, to compute the turnover of the companies listed at the exchange, we aggregate the traded value of all the companies traded on the exchange. The turnover ratio is defined as the total value of shares traded on a country's stock exchange for a particular period divided by market capitalization at the end of the period. It is used as a measure of trading activity or liquidity in the stock markets. Turnover ratio equals turnover at exchange divided by market capitalization at exchange. Now that we have understood the key indicators of the securities market, let's look at the composition of securities markets, particularly the products and participants. Let's begin with the products. Financial markets facilitate reallocation of capital from savers to entrepreneurs. Savings are linked to investments by a variety of intermediaries through a range of complex financial products called securities. Under the Securities Contracts Regulation Act 1956, securities include shares, bonds, scrip, stocks, or other marketable securities of like nature in or of any incorporate company or body corporate. Government securities, derivatives of securities, units of collective investment scheme, interest and rights in securities, and security receipt or any other instruments so declared by the central government. Broadly, securities can be of three types: equities, debt securities, derivatives. Now, let's look at the participants. The securities market has essentially three categories of participants: the investors, the issuers, and the intermediaries. These participants are regulated by the Securities and Exchange Board of India or SEBI, Reserve Bank of India or RBI, Ministry of Corporate Affairs or MCA, and the Department of Economic Affairs, or DEA, of the Ministry of Finance. Now, let's take a look at the market participants in India. Click on each key indicator to learn more. The investors are individual investors, corporate investors, foreign venture capital investors, FIIs, venture capital funds, collective investment schemes, and mutual funds. The issuers are companies, banks, financial institutions, mutual funds, government entities, public sector enterprises, state and central government, and collective investment schemes. The intermediaries are depositories, stock exchange, also first-level regulators, brokers, corporate brokers, sub-brokers, portfolio managers, custodians, registrars to an issue and share transfer agents, primary dealers, merchant bankers, bankers to an issue, debenture trustees, underwriters, and mutual funds. The exchange, NSE, provides trading in 4 different segments: wholesale debt market, capital market, futures and options segments, and currency derivatives segments. Click on each market segment to learn more. The wholesale debt market segment at NSE commenced its operations in June 1994. It provides a trading platform for a wide range of debt securities, which includes state and central government securities, T-bills, PSU bonds, corporate debentures, commercial papers, certificate of deposits, etc. The capital market segment at NSE commenced its operations in November 1994. It offers a fully automated screen-based trading system known as the National Exchange for Automated Trading System. Various types of securities, example, equity shares, warrants, debentures, etc., are traded on the system. The futures and options segment provides trading in derivatives instruments like index futures, index options, stock options, and stock futures, and commenced its operations at NSE in June 2000. The currency derivatives segment at NSE commenced its operations on August 29, 2008, with the launch of currency futures trading in US dollar, Indian rupee. Trading in other currency pairs like Euro INR, Pound Sterling INR, and Japanese Yen INR was further made available for trading in February 2010. Interest rate futures was another product made available for trading on this segment with effect from August 31st, 2009. You have now completed the topic. Over a period, the Indian securities market has undergone remarkable changes and grown exponentially, particularly in terms of resource mobilization, intermediaries, the number of listed stocks, market capitalization, turnover, and investor population. Let's take a look at the 16 principal reform measures undertaken since 1992. Principal reform measure 1 is creation of market regulator, Securities and Exchange Board of India. The Securities Market Regulator in India was established under SEBI Act 1992 with the main objective and responsibility for protecting the interests of investors in securities, promoting the development of the securities market, regulating the securities market. Principal reform measure 2 is screen-based trading. Prior to setting up of NSE, the trading on stock exchanges in India was based on an open outcry system. The system was inefficient and time-consuming because of its inability to provide immediate matching or recording of trades. In order to provide efficiency, liquidity, and transparency, NSE introduced a nationwide online fully automated screen-based trading system on the CM segment on November 3, 1994. Principal Reform Measure 3 is reduction of trading cycle. Phase 1. Earlier, the trading cycle for stocks based on type of securities used to vary between 14 days to 30 days, and the settlement involved another fortnight. The exchanges, however, continued to have different weekly trading cycles, which enabled shifting of positions from one exchange to another. It was made mandatory for all exchanges to follow a uniform weekly trading cycle in respect of scrips not under rolling settlement. Phase 2. In December 2001, all scrips were moved to rolling settlement and the settlement period was reduced progressively from T plus 5 to T plus 3 days. Phase 3. From April 2003 onwards, T plus 2 days settlement cycle is being followed. Principal Reform Measure 4 is equity derivatives trading. In order to assist market participants in managing risk better through hedging, speculation, and arbitrage, SCRA was amended in 1995 to lift the ban on options in securities. Trading in derivatives, however, took off in 2000 when index futures after suitable legal and regulatory framework was put in place. The market presently offers index futures, index options, single stock futures, and single stock options. Principal Reform Measure 5 is demutualization. Historically, stock exchanges were owned, controlled, and managed by the brokers. In case of disputes, integrity of the stock exchange suffered. NSE, however, was set up with a pure demutualized governance structure, having ownership, management, and trading with three different sets of people. Currently, all the stock exchanges in India have a demutualized setup. Principal Reform Measure 6 is dematerialization. As discussed before, the old settlement system was inefficient due to the time lag for settlement, the physical movement of paper-based securities. To obviate these problems, the Depositories Act 1996 was passed to provide for the establishment of depositories in securities with the objective of ensuring free transferability of securities with speed and accuracy. There are two depositories in India, namely NSDL and CDSL. They have been set up to provide instantaneous electronic transfer of securities. DMAT, dematerialized settlement, has eliminated the bad deliveries and associated problems. To prevent physical certificates from sneaking into circulation, it has been made mandatory for all newly issued securities to be compulsorily traded in dematerialized form. Now, the public listed companies have to make the IPO only in dematerialized form. Principal Reform Measure 7 is clearing corporation. The anonymous electronic order book ushered in by the NSA did not permit members to assess credit risk of the counterparty and thus necessitated some innovation in this area. To address this concern, NSE had set up the first clearing corporation, which is National Securities Clearing Corporation Limited, which commenced its operations in April 1996. Principal Reform Measure 8 is investor protection. In order to protect the interest of the investors and promote awareness, the Central Government Ministry of Corporate Affairs, earlier known as Department of Company Affairs, established the Investor Education and Protection Fund in October 2001. With the similar objectives, the exchanges and SEBI also maintains investor protection funds to take care of investor claims. SEBI and the stock exchanges have also set up investor grievances or service cells for redress of investor grievances. All these agencies and investor associations also organize investor education and awareness programs. Principal Reform Measure 9 is globalization. Exchanges have been permitted to set up trading terminals abroad. The trading platform of Indian exchanges is now accessible through the internet from anywhere in the world. RBI permitted two-way fungibility for ADRs or GDRs, which means that the investors, foreign, institutional or domestic, who hold ADRs or GDRs can cancel them with the depository and sell the underlying shares in the market. Principal Reform Measure 10 is launch of India VIX. Volatility Index is a measure of market's expectation of volatility over the near term. It measures the amount by which an underlying index is expected to fluctuate in the near term based on the order book of the underlying index options. India's first volatility index, India VIX, based on the Nifty 50 index option prices, was launched by NSE in April 2008. VIX is a trademark of Chicago Board Options Exchange. Incorporated and Standard & Poor's has granted a license to NSE with permission from CBOE to use such mark in the name of the India VIX and for purposes relating to the India VIX. Principal Reform Measure 11 is direct market access. In April 2008, SEBI allowed the direct market access facility to the institutional investors. DMA allows brokers to offer their respective clients direct access to the exchange trading system through the broker's infrastructure without manual intervention by the broker. Principal Reform Measure 12 is launch of Securities Lending and Borrowing Scheme. In April 2008, the Securities Lending and Borrowing mechanism was allowed. It allows market participants to take short positions effectively with less cost. Principal Reform Measure 13 is launch of currency futures. On August 29, 2008, NSE launched trading in currency future contracts in the USD INR pair for the first time in India. Trading in other currency pairs like Euro INR, Pound Sterling INR, and Japanese Yen INR was further made available for trading in March 2010. Principal Reform Measure 14 is ASBA. Application supported by blocked amount or ASBA is a major primary market reform. It enables investors to apply for IPOs and FPOs and rights issues without making a payment. Instead, the amount is blocked in investors' own account and only an amount proportionate to the shares allotted goes out when allotment is finalized. Principal Reform Measure 15 is launch of interest rate futures. On August 31, 2009, futures on interest rate was launched on the National Stock Exchange. Principal Reform Measure 16 is Issue of Capital and Disclosure Requirements Regulations 2009. In August 2009, the SEBI issued Issue of Capital and Disclosure Requirements Regulations 2009, replacing the Disclosure and Investor Protection Guidelines 2000. ICDR Regulations 2009 would govern all disclosure norms regarding issue of securities. Let's quickly summarize what we have just learned in Chapter 1. Click on each box to view its summary. Take a look at the key differences between primary and secondary markets. The key indicators of the securities market are index, market capitalization ratio, turnover, and turnover ratio. In India, the market participants are regulated by SEBI, RBI, MCA, and DEA of the Ministry of Finance. The exchange, NSE, provides trading in 4 different segments: wholesale debt market, capital market, futures and options segments, and currency derivatives segment. Take a look at the 16 principal reform measures undertaken since 1992.